But welcome everybody to our professional services webinar focused on professional services teams. We'll be talking today about changes in the tax regime as a result of Brexit, but also the pandemic, as people's behaviours mean that they might be in a country other than where they would have otherwise been if it wasn't for COVID-19. So for those who don't know BDO, we're a global professional services firm. We have over 10 billion of US dollars of turnover globally. We're in 167 countries and we've got over 90,000 staff. So hopefully whatever you need, we'll be able to help you with. So our speakers today, just to introduce you, we've got Kate Marking, we've got Louis Keeping and Simon Bird, and also Ishvinder Bedi. So if I start off with Kate as our first speaker. So Kate is a senior manager focused on giving expatriate tax advice. She's got over 12 years of experience on advising clients on tax, social security and compliance obligations relating to secondments, whether they're business travellers and other cross-border issues. And Kate today will cover our social security points in terms of the implications of Brexit. Next up, we've got Louis. And Louis Keeping is an associate director and sits with me within the professional services tax team. Louis advises on a broad range of partnership structure for professional service firms and is specialised in the area for over 8 years. So Louis will pick up on the more corporate types of issues resulting from people being displaced, whether by choice or through COVID restrictions. So following in Louis's footsteps will be Simon Bird. And Simon will pick up on the DAX 6 regime resulting from Brexit. So hopefully that's a bit of a relief for some people when we get to that point. So Simon is one of our directors and specialises in international tax aspects of cross-border structuring, with over 13 years of experience of working with international businesses, and is well versed in DAX 6 matters and in fact trains people on the area. And then last but not least, we've got Ishvinder Bedi. And Ish will cover the VAT implications of Brexit when it comes to professional services firms. So Ish is one of our assistant directors and has got over 12 years of experience and regularly supports professional services firms on a variety of matters, whether that be VAT controls, determinations and recovery, but also works on the application of the disbursement rules changes, and also ensuring that clients have got the making tax digital down to a T. So just in summary, in terms of our agenda, we're going to be discussing social security considerations, permanent establishment issues, DAX 6, indirect tax, and we'll cover at the end any questions that you have as we go through. So the Q&A button at the bottom is where to place your questions. And as we've got time, that we'll pick those up at the end or cover them off after the webinar. And we will finish within the hour. So I'll get going and hand over to Kate. Kate, over to you.
Thanks, Anna, and hi, everyone. So the main aim of this presentation is to discuss the social security situation for your cross-border worker population in light of Brexit and the new protocol on social security coordination. I am also going to touch on the rise of the displaced home worker. Next slide, please. So the basic rule of social security is that you pay social security where you work. The employer obligation always follows the employees. So therefore, if an employee has to pay UK social security, for example, then the employer will also have a UK social security obligation. It's easy to consider the EC regulations 883/2004 as the old rules. However, these are still in force and will continue to govern the social security of cross-border arrangements involving the UK and the EU EFTA countries, which started before 2021, as well as the social security of current and future cross-border arrangements involving EU member states and the EFTA countries. Under these regulations, social security is only paid in one country. Posted workers are eligible to remain in their home country social security regime for up to 2 years. However, you can get an extension for up to 5 years home country social security coverage as long as it's in the employee's best interest. Multi-state workers are workers who spend at least 5% of their time working in 2 or more EU states. Under the EU regulations, they'll generally pay social security in the country where they're habitually resident, provided they perform significant activity in that country, which is defined as 25% of either their remuneration or their time. Next slide, please. So the trade deal includes the new protocol on social security coordination, and this will govern the social security for cross-border moves between the EU member states and the UK from 1st of January 2021. It largely replicates the EC regulations. So again, it's only possible to be within the social security legislation of one country at a time. And therefore there cannot be a scenario of compulsory double social security contributions. There are, however, some key differences. So detached or posted workers, that is, people who are sent on secondment by their employer, can only remain in their home country social security system for a maximum of 2 years, and there's no longer any potential to extend this. So if you have an assignment that's intended to be, say, 3 years, employee and employer social security will be due in the host country from day one. So this can have a really big impact as social security rates vary greatly across Europe. The UK, I'd say, is comparatively cheap sometimes compared to other EU countries. France, for example, has a top rate of social security of 45% compared to a top rate of UK employer social security of 13.8%. You may have heard that countries could opt out of the detached worker rules, and they had until 1st of February to make that decision. However, all EU countries have now opted into the rules, so these rules will always apply. The rules also allow for self-employed individuals to continue to be subject to the legislation of their home country, provided they're pursuing a similar activity and the anticipated duration is for no more than 2 years. The new protocol is nationality blind and therefore applies to non-UK and non-EU nationals. However, the rules don't cover the EFTA countries, which are Switzerland, Norway, Iceland, and Liechtenstein. Next slide, please. So on that note, there are special rules for cross-border situations between the UK and the EFTA countries, which started after 31st of December 2020. In these cases, we revert back to the pre-existing reciprocal agreements we had with these countries prior to the existence of the EU rules. And we have agreements in place with Norway, Switzerland, and Iceland. Each agreement will need to be closely looked at to determine the rules when you have employees working in these countries or coming to the UK from these countries. For example, posted workers between the UK and Norway can be covered under their home country social security for 3 years. These agreements are really old. I think the Swiss one is from 1968 or 69, and there can be implications as well for multi-state workers. For example, in the Swiss agreement, there's no provision for multi-state workers. So to the extent that you'd have someone performing duties in both the UK and in Switzerland, the social security liability will actually have to be split between the UK and Switzerland. We do understand that the UK is seeking to conclude a new comprehensive EEA EFTA-wide agreement on social security coordination, including healthcare, as well as a new reciprocal agreement with Switzerland as soon as possible in 2021. So hopefully this gets resolved shortly, but at the moment we do have to look back at the old agreements. Next slide, please. So as an employer, what do you need to be looking out for or concerned about? The first step is to determine in any cross-border situation which countries are involved. And these can be split into 3 categories. So you've got the EU, you've got the reciprocal agreement countries. So for example, the US and now also Norway and Switzerland. So these are the countries that have a direct social security agreement with the UK. Or countries can be classed as the rest of the world. In these cases, there is no social security agreement. The social security liability will follow each country's domestic rules, and there can be a risk of double social security contributions. So for example, a UK outbound secondee always needs to pay UK NIC for the first 52 weeks they're abroad. You also need to consider when the cross-border arrangement started. If it's before 2021, then it's covered by the EC regulations, which can have a big impact. So for example, a UK to France secondment which started on the 31st of December 2020 could be covered under UK Social Security for 5 years, as opposed to 2 years if it started on the 1st of January 2021. Another example would be a multi-state worker across the UK and Switzerland. So if that arrangement predated 2021 and there hasn't been a change in circumstances, then it's possible to get a multi-state worker A1. However, if it started in 2021, then both UK and Swiss Social Security will need to be paid. When considering new secondments, the length of the secondment needs to be carefully considered. So for example, you may need to limit the secondment to 2 years just to ensure home country social security coverage. It's also really important that proposed secondments are properly costed up prior to agreement, so that as an employer, you're aware of the potential costs before any contracts are signed, as the social security can make a really big difference. You'll also need to make sure that all A1 forms required are applied for. For the UK, the process of applying remains essentially the same. If the social security liability switches to another country, it will be necessary to investigate how you make those social security payments. Sometimes it can be done by the employee on behalf of the employer. However, a host country payroll may be required. The protocol largely mirrors the healthcare arrangements existing under the EC regulations. So EHICs provide access to healthcare services across the EU for temporary stays. All EHIC cards already issued will remain valid until their expiry date and can be used in the EU. Once an EHIC expires, or if a certificate is required for the first time, HMRC is now going to issue what they're calling a global health insurance card, or a GHIC. The S1 scheme will also still apply. So this will allow individuals to receive ongoing health and social care in another country. However, if employees are traveling to EFTA countries and not eligible for an S1, then you should ensure that they're taking out the appropriate insurances and private medical cover for the time they're spending in these countries. Next slide, please. Of course, Brexit's not the only thing we've had to deal with over the last year or so. The coronavirus pandemic has massively affected working patterns and is also likely to have a big impact on the future of global mobility. So we've seen many cases of employees returning to their home countries for personal or well-being reasons. There's a lot of signs that international remote working will continue after the pandemic. Many employers will be aiming to reduce their real estate costs, and now also realizing that home working can be effective, looking to keep and attract staff from a larger workforce. There's many benefits for employees too. They can get a better home life balance and the ability to live somewhere not dictated by office location. Big name companies such as Facebook and Microsoft have publicly affirmed their commitment to either long-term or forever home working. It's therefore really important that companies consider having a remote worker policy as part of their future business strategy. Next slide, please. So one of the reasons it's so important to have a remote worker policy is that working in another country to the one you're employed in has impacts on corporate tax, personal income tax, social security obligations, employer compliance obligations, and employment law, just to name a few. Employers will need to balance the risk of creating additional compliance obligations and costs versus meeting the wishes of their workforce. Employers therefore need to carefully consider where they're going to draw that risk line and make sure they have a detailed policy in place to set out what's allowed and what's not. It's also really important that employers know where their staff are working and have a tracking mechanism in place.
Yeah, and Kate, that's a really good point, isn't it? Are you seeing many employers deciding to put home worker policies in place? And
yes.
Where are your clients drawing that risk line that you've talked about?
It's a really hard one, as there's no actual magic number of what is a risk-free amount of time to spend working in another location. So what I'm seeing is some companies being really strict and saying it's not allowed at all in another location, or, you know, we'll only allow it for a week or two under specific circumstances. However, some of my clients are sort of saying, well, we feel it's vital to retaining our staff to give flexibility in this area, and so they're much more willing to take a further risk, and even to the extent where they'll set up shadow payroll operations in other locations and accept the additional cost of switching social security liability to another country.
Yeah, fascinating to see how this all plays out over time.
Yeah, definitely. Next slide, please. So I know some of the impacts on remote home working are going to be covered elsewhere in this webinar. So I just really wanted to concentrate on the social security aspects. If you have an employee working in another country, there is the risk that the country where social security is paid will switch to the host location. And as we've seen when I was discussing Brexit earlier, this has a really significant impact on the employer costs. And in addition, you can also find yourself with those compliance obligations. So either running shadow payrolls in other countries or making sure that the appropriate A1 forms or certificates of coverage are in place. So the longer the situation continues, the more risk there is of creating that host country obligation. There has been leniency because of the pandemic, and generally you wouldn't expect there to be much of an issue for short periods of home working in another location. However, what we've seen a lot is people initially intending to be out of the UK for a month or two, and that just getting extended and extended. Therefore, it's advisable that an A1 or certificate of coverage form is applied for to protect the social security position. It does beg the question of which form. These aren't technically postings where someone is being sent by their employer to another location. However, it doesn't really fit a true sense of multi-state working. Plus, with the multi-state worker rules, you run the risk of being seen to be habitually resident in the host location, resulting in host country social security. So to date, our experience is that HMRC is processing posted worker A1 forms for displaced UK workers. So that at least is really good news for UK outbound employees. And finally, please just note that while I've been sort of mainly focusing on the EU, there are particular complexities with individuals coming to or from countries that don't have a social security agreement in place with the UK. So that's just one to be aware of. And that's it for me. I think there's possibility, obviously, to ask questions, and we'll run through any questions raised at the end. But thank you very much for your time, and I'll pass over to Louis.
Thanks, Kate. I think I've unmuted, so that should be a good start. Just wanted to take this opportunity really just to follow on from what you've discussed around the social security impact on movement of people, and kind of consider what the associated permanent establishment risks might look like. I'm going to cover the direct tax permanent establishment risks, and it should be noted that indirect taxes, VAT, etc., have got different permanent establishment rules, and I'm not going to cover those today because I don't consider myself an expert in those areas.
And Louis, there's been so much change, isn't there? So have you seen a real shift in requests from clients coming in? I guess from a year ago now, since March, when lockdown really first started to begin. Yeah,
so I think most people probably have the same experience, that it kind of initially started with people being stranded in a jurisdiction where they've been on holiday or decided to kind of go overseas for a couple of weeks, and therefore the requests were very much along the lines of, we've got individuals who are stuck in an overseas jurisdiction. What does this look like? What do I need to consider from tax and permanent establishment positions? To very much now a shift in individuals wanting to move overseas. They're kind of finding at the moment, we don't know how this is going to play out, that they can work remotely. They want to work in a different country. And in fact, we're even seeing people do this without telling their employers, which causes even more problems in terms of creating late filing issues and other areas that should have been considered. So I think, as we've seen at the moment, firms are probably taking quite a few different views on this. Spotify, the most recent, who said they'll come out and said individuals can actually work from anywhere. But other firms are taking a more stricter line and wanting to monitor in detail where their staff are and providing strict regulations of where and when they can work. And I think as Kate very much talked about, the most important point, I think, is that there's an adequate governance and procedural framework that is in place just to prevent unwanted filings, admin obligations and penalties and late filing. I think is also important to consider.
Yeah, and so what is your suggestion to people, given so many moving parts, particularly around the permanent establishment aspects, as you say, the filing obligations, the admin that comes with it, but also the penalties, etc. So what specifically should you be suggesting to people?
It is really difficult, isn't it? Because you want to kind of please your staff as much as you can and accommodate what their needs, but you also need to consider your firm's needs. So I think, as we talked about, it's definitely you need to have the adequate framework in place. I think we've seen that in January 2021, the OECD kind of released updated guidance, which is an interesting read on tax treaties and impact of COVID-19. I think a note of caution on that each country should be analysed in its own specific circumstance, and you can't just apply a broad brush, but it is a useful read. And I'm going to probably focus quite a lot on that today, given it's probably the most topical and how recent that is. And I think kind of the guidance considers that the interpretation of tax treaty articles on creation of PEs, residents of companies, individuals, as well as the taxation of income from employment is really useful in understanding that interjoined with the impact of COVID-19 and the health issues. And it's certainly a useful update on what was released in April 2020. The guidance definitely recognises that some businesses, as we talked about, are concerned that employees could create a PE if they're working from home in another country where they regularly work. And we've already discussed from a social security position what this might look like, but it will also create other tax and filing obligations for the business.
Yeah, so picking up on what the Home Office has said then and the associated PE risks, what's the key aspects in that?
I think we automatically look at Article 5 of the OECD model, and those well versed in tax and finance probably well aware of what's detailed in that article. The issue of which is kind of, you look at a fixed place of business and it's based on facts and circumstances, but also that the fixed place of business must have both a degree of permanence and be at the disposal of the business. So digging into that a little bit deeper, even though part of the business may be carried on at a Home Office, that should not automatically lead to the conclusion that the Home Office is at the disposal of the business. So carrying on an intermittent business activity at a Home Office doesn't make the Home Office at the disposal of the business. So a Home Office may be a permanent establishment, though, if it is used on a continuous basis for carrying out the business and the individual is required to use the Home Office to carry out the business. So there's quite a few different terms that you need to be aware of there. I think then you need to look at whether the employee is required by the business to work from home. So the guidance considers that individuals working from a Home Office as a result of a public health measure, i.e. COVID-19, or recommended by at least one of the relevant countries are not doing so because of any requirement from the business. So also need to think about if an office is still provided by the business, which in the absence of public health measures would be available to the employee. So what does that really mean? The guidance kind of indicates that working from a Home Office as a result of public health measures wouldn't create a fixed place of business, permanent establishment. And that's either because the arrangement lacks a sufficient degree of permanence or the Home Office is not at the disposal of the business. But the Home Office may be considered to have a degree of permanence if you look at an individual who continues to work from home once that public health measure is over, or the recommendation by the government has finished. And therefore, following any permanent change to the individual's working arrangements, you then need to look at the facts and circumstances to kind of determine whether the Home Office is at the disposal of the business, and then if a PE is therefore created.
Yeah, and as always, getting into the facts and the detail is what you have to do in each case.
Yeah, very much so.
Has there been any update on the guidance with regard to dependent agents and how this would create a PE?
Yeah, so dependent agents is always quite an interesting read. So I think under the current OECD model, as we know, a dependent agent permanent establishment arises where a person habitually concludes contracts or plays the principal role leading to the conclusion of the contracts on behalf of that non-resident business. We've known that for some time, but the guidance considers that if an employee or agent is only working from home because of the public health measure or recommended by the government, the activity is unlikely to be regarded as habitual in that circumstance. So therefore, a dependent agent PE shouldn't arise. And this is kind of where I've certainly had lots of questions from my clients. And kind of a different approach may be appropriate if you look at where the individuals habitually concluding those contracts on behalf of the business before the pandemic, and equally if they continue to do so after the pandemic, is at that point it's more likely that under the guidance the employee would be considered to conclude contracts in respect of that non-resident business and the PE issue to be more strong. So I guess kind of following on from that, probably want to look around corporate residents and individual residents. I think that's another important area, and what the guidance has raised. Obviously the pandemic's probably raised a lot of questions around changes in effective management of a company, given the relocation of board members and senior executives, initially those that were stuck in another country because of the pandemic, and now those who are looking to relocate on a more permanent basis. And kind of the guidance considers it unlikely that the COVID-19 situation will change any entity's resident status under tax treaty, which is useful. But a company is considered, if a company is considered as a resident of two countries under domestic laws, tiebreaker rules will then apply. And you need to look at whether it's a provision similar to the 2017 OECD model tiebreaker, where the competent authorities look at dual residence on a case-by-case basis by mutual agreement. And if it's a pre-2017 OECD model tiebreaker, then the place of effective management is the only criteria used. So that's an important difference. Based on the OECD model, the guidance considers that all relevant facts and circumstances should be examined to determine the usual and ordinary place of effective management, and not only those to an exceptional period given the COVID-19 pandemic. So again, a useful update. It also concludes that the treaty tiebreaker outcome is unlikely to be affected by individuals participating in the management and decision-making of entity cannot travel as a result of the public health measures. So again, nice to know. Moving on from the companies to kind of individuals, the guidance indicates that the tax residents of individuals, their treaty residents, wouldn't normally be affected by the temporary dislocation from their normal place of work because of COVID-19, but it does go on to consider two distinct situations. So where an individual who is normally away from home, given a holiday perhaps, wishful thinking perhaps at the moment, and stranded in a host location, and where a person who has become tax resident in a country where they're working returns to their previous home location as a result of COVID-19. So perhaps picking up on the first case, I think the guidance suggests the individual would be unlikely to become resident in the host country, but it does go on to say that if they would normally remain treaty resident in the home country under the tiebreaker in the relevant treaty. Looking at the second case, if there is a recognition that while a return home might not change anything, if it was exceptional and temporary, the position could be more complex. If there's, for example, connection to the previous home remains stronger than those to their working and residence location immediately before the pandemic. So I guess the underlying theme is, in practice, determining the treaty residents of individuals in the second group is going to be more complex, and you'll probably need to take advice on this, especially where government-imposed restrictions are lifted. And the guidance recognises that returning to the previous home location might be regarded as kind of a tipping point to provide ties to that country rather than to the pre-pandemic home. So I think it's key to look at those more complex cases in detail and look to seek advice. And just quickly, I think the final point I wanted to consider was just around income from employment. The guidance considers the 183-day exemption in the employment income article of the OECD model, which we know, and to the extent that COVID-related days can now be ignored in that 183 days. Also to note, the OECD commentary permits the exclusion of days given sickness, and other exemption days also still count. And the guidance confirms that where an employee is prevented from travelling because of public health measures, it's reasonable to ignore such days, but recognises that not all countries will take that view. So you again need to look at a country by country basis. And firms are encouraged to liaise with the local tax authorities.
That's great, Louis, thank you. And just quickly then, what are the key takeaways and comments that you would want people to really hold in their minds when they're thinking about this?
I think this is a key theme, not only in Kate's, but also mine. I think you just need to have that adequate framework in place to monitor your staff, where they're going, what they're doing, and having some formal guideline to give them indications on where they can go, what that might look like, and what issues that might arise. So they've got some guidance to follow, because otherwise, as we've seen with firms and my client base, employees will just go off and relocate without telling host countries, and then you've got the issues that arise afterwards, so being reactive instead of proactive.
Yeah, and one size doesn't fit all, does it?
No.
unfortunately. Right, okay, great, thank you. Right, so moving on to Simon. Simon, over to you.
Yeah, thanks, Anna. So, hi everyone. I'm going to talk a little bit about DAC 6 and just some of the changes that that have happened in the last kind of couple of months. But just if we move into the next slide, just before do that quick level set in terms of what is DAC 6, a quick reminder. So, this was the EU's directive, which was all targeted at tackling aggressive tax avoidance arrangements, or should I say, what they perceive to be aggressive tax avoidance arrangements. So it looked at cross-border arrangements, and where they met certain hallmarks, they were reportable to the local tax authority within the EU. The primary responsibility was on what was known as an intermediary, which at its kind of highest level was anyone who provided aid, assistance or advice in respect of that cross-border arrangement or the implementation of that cross-border arrangement. So a lot of ourselves and various professional services firms all fell within that category. But there was a fallback position whereby if there is a fallback position whereby if the intermediary doesn't have to report or doesn't choose to report, then it defaults onto the relevant taxpayer. So there's no way that a transaction could fall through the cracks. I say the idea was that all of these transactions will be reported to the local tax authority in the EU, and then on a quarterly basis there'd be an automatic exchange of information about those transactions between relevant EU tax authorities. And the expectation being that it gives them a lot more information in much more real-time basis to be able to target their audits and inquiries into taxpayers' affairs. In terms of the kind of timeframes we've set out there, just what the reporting deadlines are in most EU countries. So there was a transition period going back as far as June 18 up until June 2020, and those only arrangements that were implemented within that time frame need to be reported this week. Anything in the second half of the calendar year 2020 should have been reported by the end of January, and from 1 January onwards we're into the full rules where you've got 30 days to report an arrangement from the trigger event date. The one slight caveat with that, and it becomes relevant when we talk about sort of the interaction between the UK and the EU, is that not all EU jurisdictions decided to take this 6-month deferral because of COVID to the dates that you can see there on the slide. There were some territories that decided to stay with the original reporting dates. So anything from the transition period needed to have been reported by the 31st of August, and 1 July 2020 would be the date for the commencement of the rules and 30-day reporting. So one to just watch out for there if you've got presence in other jurisdictions, that actually the dates are more advanced than on the slide. And I think it's Germany, Austria, Finland are the ones that, and Poland are the ones that come out as often being quoted as having not made that deferral and having earlier implementation of the rules. So that's a quick, very quick canter through of the overview of the DAC 6, and I think next slide will just kind of flash up on what those hallmarks are as a reminder. So I won't go into all of these in detail, but 19 hallmarks within the directive. Designed to be evidence of, as I say, what the EU considered to be aggressive tax avoidance. Some of them are subject to what's known as this main benefit test. So not only do you need to meet the conditions within the hallmark, but you also have to have a main benefit of achieving a tax advantage of entering into the cross-border arrangement. And those are the generic, specific and certain cross-border arrangements on the left-hand side of this slide. On the right-hand side of the slide, and these are the ones that caused a lot of issues for advisors and taxpayers, these are ones that are not subject to the main benefit test. So if you just meet the factual test within the hallmark, then they were reportable. And these are the ones that certainly in my experience are the ones that caught a lot of just very vanilla transactions, which had no sort of tax incentive or tax motive to them, just purely commercial transactions that were then falling within the scope of the rules. And that was particularly the ones that are listed there as transfer pricing, where you've just got cross-border transfers of assets or functions involving someone in the EU. I'll just quickly call out, because they'll be relevant to the next couple of slides, is the Hallmark D ones. So these are the two hallmarks within Hallmark D, where you have a cross-border arrangement that's designed to undermine the automatic exchange of information and also arrangements where there is an element of non-transparent or not able to identify the beneficial owners within the transaction. So very, very quick canter through of what is the DAC 6 rules there, and I guess the question is, so what has changed as a result of Brexit? So if we just flick on to the next slide. So we had obviously free trade agreement signed just before Christmas last year, and there was a interesting reference within the thousands of pages of that text that saying that the parties agreed not to reduce the standards on the automatic exchange of information below the level provided by the OECD. And so the UK government jumped on that and decided that it meant they didn't need to implement the full scope of the DAC 6 rules. They only needed to implement the rules to the extent that they were aligned to the OECD's mandatory disclosure regime. And the opinion being that that means that it's only the category D hallmarks that are now relevant from a UK perspective. So at about 2 o'clock on the 31st of December, a surprising email hit everyone's inbox to say the government had laid a statutory instrument which essentially struck through the previous regulation, deleting A, B, C, and E hallmarks, and making some other kind of brief amendments to that instrument to make sure it worked from a UK perspective. But it means that it's now a very limited number of transactions and hallmarks that are relevant from a UK perspective when considering DAC 6. And what they also said as well, that they will release a consultation throughout the course of 2021, where they intend to actually put legislation in place to implement the OECD's mandatory disclosure regime, and essentially repeal the statutory instrument that we had that implemented DAC 6 within UK law. I haven't heard a specific date of when that's going to be released, but given that I think the consultations they've said are coming out towards the end of March, the ones that aren't immediately relevant to the budget, I expect that's a good estimate for a date that we might see something on what that consultation is going to look like and what the potential new UK rules on mandatory disclosure will be when we get through that.
Well, thanks, Simon. And we're all becoming very used to dealing with very ad hoc, very immediate points that are coming out and having to react to it. So what has the reaction to all of that news been from the actual advisors? Who are the intermediaries?
A good question. So I think there was a mix of relief and annoyance, if I'm honest. So relief in the sense that, as I say, the rules were very broad and captured a lot of transactions, ones that were quite vanilla, and a lot of businesses, whether that be intermediaries, even banks, had put a lot of processes in place to have to deal with this. It was quite a key risk management process that everyone needed to put in place. So relief that is now simplified to a great extent. Annoyance in the sense that 2 o'clock on the 31st of December, the day before the rules were about to be implemented, is not the best time for the government to be repealing legislation, and particularly because a lot of people have been having conversations with HMRC about the rules and interpretation of the rules all in the run up to Christmas and even between Christmas and New Year, and there was no mention of Brexit impacting and repealing the rules. So slight frustration and annoyance, I think, but ultimately a relief that these rules are relaxed quite significantly from a UK perspective for a number of businesses.
Yeah, okay. And what about DOTAS regime? Has that had any change to that because of it?
So it's a good question. No change at all to DOTAS. That still is in place from a UK perspective. It's not changed at all. It's just purely these additional rules that were around DAC 6 that have been amended as a result of this change.
Great, thank you.
So I guess that's what has changed. Now, I suppose what does that really mean is the kind of key question for lots of intermediaries. So, as I say, the vast majority, I think, of intermediaries will be very happy with these changes. The reduced requirements mean that it's very difficult to see arrangements that will fall within the DAX within the category D hallmarks. So I think a lot of people will be relieved that they don't have to make those reports. When you think about all the things that those targets about identifying beneficial owners and those kind of things, there's various checks from an AML and know your client perspective that already target those. So I have heard it said that if you've got something that was reportable under hallmark D, you've probably got some bigger problems than just maybe your DAX 6 reporting requirements in terms of knowing your client and identifying those beneficial owners of structures and things. So that's, I think, is the positive, but there are still some things to watch out for which are causing some headaches for intermediaries where they have specific facts. So the first one being the definition of an intermediary and having EU nexus is broader than just where you are based. So having a permanent establishment or branch based in an EU country would give you nexus in that territory. So UK intermediaries with a German branch will still need to consider the full rules in respect of that German branch in Germany, and so they may still need to make reports and disclosures under the German rules. So it's not a complete fall away for those intermediaries. There's also an interesting point about kind of care, I guess, and thinking about your employees, in that one of the other ways that you could be an intermediary under the rules, where you are regulated by a professional body in relation to tax in a member state. So if a UK intermediary has a French employee who's subject to the equivalent of French tax professional body, there's a question to be answered there around what does that mean for that employee, and do they have any kind of obligation within France, as an example, or any other the EU member state, and how will that be managed? Under the UK rules, the way it technically worked was that all employees were intermediaries where they provide those advice, but where they were employed by an intermediary, they were exempted from that obligation. And will that still hold true now if you're employed by a UK intermediary, which France doesn't consider to be a member state of the EU? Those are kind of, I suppose, ways that you might still have to consider the full rules and think about where reporting obligations in those EU territories. But it's also, I guess, important to remember that there is still an element of DAX 6 in terms of those category D hallmarks. Yes, it will be simplified in terms of only focusing on those and not the broader arrangements, but there is still a requirement there for intermediaries to consider those rules, and if they do fall within the scope of category D, make those reports within the UK. So whilst the risk management processes that are needed to ensure you're compliant with DAX 6 are still required and simplified, it's worth considering how you can combine them with your existing processes around AML or know your client and take on and things like that, just to make sure that DAX 6 is still being considered and nothing potentially falls through the cracks in terms of being reportable alongside your current risk management processes.
Yeah, great. So it's important not just to assume that it's everything is covered by the relaxation effectively, and sort of.
Yes, it'd be very easy to think DAX 6 is gone and I don't need to think about it, and that's not quite right. You still do need to think about it a little bit. And I guess there's also a point with this consultation coming up. We don't know what will be required in that until we see that document. So having a good process in place to pick up those category D hallmark ones will likely stand you in good stead for the consultation and the OECD's MDR in the future anyway.
Yeah, okay, brilliant. Thanks, Simon. Okay, let's move into VAT aspects, and we could have spent the whole hour talking about that, but we've tried to narrow Ish's focus into a few areas. So over to you, Ish. Thank you.
Thank you. So I think to first off, so if you move on to the next slide. So there's quite a few things to pick up on beyond kind of Brexit. So we want to start with imports and exports of goods. Appreciate with the caveat that obviously most of the people on this call will be focused on services, but it's really just to note that yes, we do have an EU-UK cooperation agreement, which is obviously great because it means that there should be customs relief on goods moving between the UK and EU. However, it's not always as clear cut as just automatically getting relief. You may have seen in the news things around M&S having issues with Percy pigs, for example. That's because the goods were coming from Germany into the UK and then going from the UK back into Ireland. And so when it went into Ireland, the question came up as to whether you could show that those were originated from the UK, which you couldn't because they originated from the EU. And it's very obviously very circular, but duty was potentially applicable in that case. So it's the key point we wanted to draw upon is if you're moving goods cross-border between the UK and the EU, duty relief isn't always guaranteed. So it's always worth just thinking about that in a little bit more detail. Also, because of Northern Ireland Protocol, it means moving goods to and from Northern Ireland has also become a lot more complex. So if you are doing that, again, for whatever reason, it could be because you're setting up an office and so on. Again, it's worth then having a discussion as to what that could potentially mean for you. There's also been changes around postponed import VAT accounting. So previously, prior to 1st of Jan, if you were importing some goods, you would pay VAT at the border or through your deferment account, and then you would recover that import VAT through a C79 certificate at a later date. What's happened now is that you can, as long as your freight forwarder ticks the right boxes on the declaration, you could actually recover that VAT and pay that VAT on your VAT return at the same time. So it's effectively an in and out, creates no cash flow implication for you. So it's worth, again, making sure that you're aware of that as and when you need to do any imports. There's also changes to import valuation or import VAT calculations for consignments worth £135 or less, and that effectively shifts you from no longer having to account for import VAT, but only accounting for import VAT at the supply point. So again, low value consignments can often be something that happens with professional services firms. If you're moving some goods around the various member firms in your network, it's just worth thinking about. So all in all, if you're exporting goods to and from the EU or moving them to and from Northern Ireland, you probably shouldn't be speaking to a customs specialist because obviously a lot of professional services firms won't have that specialism in-house. Cool. So if we move on to the next slide. So in terms of sales of services, so obviously you can break this up between B2B and B2C. So in terms of B2B supplies, largely hasn't changed. So you would still treat your supply as outside the scope of UK VAT. You would expect the customer to apply the reverse charge in their local country. We would still expect you to collect the VAT number so you can prove their location, because obviously that will be an important point to prove to HMRC. You should also still reference the reverse charge on your invoice. So again, it's quite clear what the VAT treatment is meant to be. But at the very least, whilst all that's still the same, you won't have to submit easy sales list anymore. So at least that's a plus. In terms of B2C, so picking up on supplies of consultants, lawyers, accountants, or similar services, those prior to Brexit were treated as subject to UK VAT if the counterparty, so the individual, was based in the EU. But it would be outside the scope of VAT if they were based outside the EU. That's now changed to say if they are based outside the UK, it is now just outside the scope of UK VAT. However, as you can see, we have one caveat around that, which is that we may need to consider use and enjoyment rules in other EU member states to see how they apply the place supply rules in certain situations and whether that could potentially mean local VAT. Also worth picking up on specified supplies. So there are specific VAT exempt supplies, which if you previously provided to a counterparty based outside the EU, that would allow you to get some VAT back on your costs that you've incurred in regards to that. But from the 1st of Jan 2021, that was extended so that if the counterparty to these qualifying services was based outside the UK, even though it'd be a VAT exempt supply, you could still get your input tax recovery. Obviously, that'll be a huge change, particularly in financial services and the like. We also wanted to pick up on fiscal representation because this is a point that just seems inconsistent across the EU. So upon leaving the EU, fiscal representation for overseas VAT registrations became more of an issue for UK businesses if they had an overseas VAT registration. It became an issue because of the need to for someone locally to be jointly and severally liable, which obviously meant you'd have to pay some fees for that. And it would also mean that you'd have to give some form of guarantee to mitigate their risk. Now, because of the UK-EU cooperation agreement, a number of countries have come out and said, well, we don't actually need that because there is mutual assistance clauses in the agreement, but it really depends on each EU member state. So it needs to be looked at on a state-by-state basis. Great, and moving on to the next slide. So picking up on some bits around the houses. So mini one-stop shop, electronically supplied services. We've seen professional services firms provide, for example, e-learning and even software licenses, and don't necessarily have controls over who their recipient is and whether they're in business or not. So a lot of them have actually ended up registering for MOS. We no longer have access to that. So if you still need to use it, you should register in another EU member state for the non-union MOS scheme. And obviously that will be a lot better and a lot simpler for you than, say, registering for VAT across the EU. Land-related services. So this is obviously an issue that a number of professional services firms, particularly law firms, architects firms, etc., can deal with in terms of working out whether their service is seen as land-related or not, and whether it's potentially subject to local VAT or not. So previously, HMRC's guidance used to refer to the EU's explanatory notes on immovable property. That reference is now removed. So obviously it's just relying on the UK's position on this. And the main thing that we wanted to draw upon is the fact that because of that, there could very well be a divergence between how the EU and how EU member states interprets land-related services and how the UK interprets these services. And so whether there could be some sort of implication where, you know, it may be seen as land-related in the UK, but not land-related overseas, or vice versa. So basically monitoring both interpretations will really be key. And then just for the avoidance of doubt, we also wanted to flag that in terms of Northern Ireland and services, that is going to be aligned to the UK for services. So the Northern Ireland Protocol is very much focused on goods. Next slide. Okay. So in terms of purchases, again, in terms of the B2B purchase of general services, that should still stay the same. So we would still expect UK firms to account for the reverse charge. We still expect UK taxpayers to retain evidence of the location of their supplier. One, being able to show that you've done the right VAT treatment, but also just generally, there's obviously an increased requirement around maintaining controls and processes and really showing the steps that you've taken for HMRC to show that you've got to the right VAT determination. And so maintaining that evidence, I think, is always key, and really kind of shows you've got good controls in your business. If you do incur VAT overseas, particularly in the EU, it's worth noting that the VAT refund system can still be used up until 11 p.m. on the 31st of March 2021. After that, the 13th directive reclaim process could potentially be applicable, but it is very onerous, typically requires paper forms to be submitted in the local language, along with original invoicing and so on. And still there has to be a mutual recognition. So there can be, in certain situations, a tax authority may just reject it outright. So it's never guaranteed, and it's a lot more difficult. And then finally, we just wanted to make a point of saying that the EU place supply rules really remain unchanged. It's just how they interpret them for UK businesses, because they will have their own place supply rules that will need to be considered. But we are now no longer part of the EU, so we will be considered a third country when they then apply their rules to us. Which brings us on nicely to our next slide, and use and enjoyment, which, you know, obviously, if anyone attended the previous workshop that we attended, use and enjoyment obviously played a big part of that as well, and it does here today as well. So what is use and enjoyment? Effectively, use and enjoyment are rules that each EU member state can apply to effectively tax a certain type of supply in their country if they think it's been used and enjoyed there. So to take an example, in the UK, we have use and enjoyment on electronically supplied services for B2B supplies. So to take the example, prior to Brexit, if you had a supply to a US company of software, but actually it was being used and enjoyed in the UK, arguably that should be subject to UK VAT. And likewise, if you are charging a UK company for a software in the UK, but actually you knew they were enjoying it in the US, arguably potentially not subject to VAT. Now those rules are changing from the UK perspective. Before it was if it's UK or non-EU, now it's UK or non-UK. So the terms of use and enjoyment in the UK have become broader. It's also worth noting that the application of use and enjoyment could very well become broader, because it could be applied in other types of supplies. So obviously we've flagged some of the supplies that are caught in the UK for now. There's nothing, we don't know how the UK will apply this going forward. Finally, the key point that we wanted to also draw upon was the fact that, like we said before, the EU's place of supply rules haven't changed, but the interaction of the UK now being a third country and no longer be a member of the EU means that the application of those rules to us now does change. And that specifically covers use and enjoyment. So if you took the example that I mentioned with software before, we are now a non-EU entity or non-EU businesses. So the EU's use and enjoyment rules could apply to us. And so that could have two impacts. One, it could mean that if you incurred some services from a supplier overseas, they may think use and enjoyment applies and they may charge local VAT, which then may become difficult to recover. Secondly, because use and enjoyment could potentially apply to the services we provide, it could potentially result in the implication for UK firms to potentially have to register for VAT overseas, on the basis that use and enjoyment rules apply and that the customer can't self-account for the VAT under the reverse charge. So again, that's something to look out for, and then that is something that has to be determined on a case-by-case basis on each EU member state, because they apply use and enjoyment so differently across the EU. And then moving on to the next slide. So these aren't Brexit issues per se, but these are some major changes that are coming up that we wanted to bring up. So firstly, we've got Making Tax Digital. So everyone probably has been filing their VAT returns via an NTD compliant MPI. That's just the first phase. It's worth flagging that there is a second phase to this, which is making sure that you've got your digital records and that you have effectively a digital audit trail from the extraction of your data from your system all the way to the submission of your 9 boxes to HMRC. So things like manual copying and pasting of data is not going to be allowed. Certain types of manual adjustments that HMRC considers should be done through your actual system. All these types of processes need to be reviewed and analysed to determine what will be compliant with MTD and what won't be compliant with MTD. And then you need to start thinking about what the implications are and what changes you need to make. There's also the domestic reverse charge for construction services. So in most cases, this doesn't necessarily affect a lot of the business, apart from the fact that you could very well be the end user. So you could be the recipient of some of these construction services. And it's just a point to flag that in those situations, if you are an end user, the domestic reverse charge shouldn't apply as long as you certify to your supplier that you're an end user. So you need to give something in writing to them. So again, it's worth just thinking about what the implications could be for your business if you're incurring some construction services. And then finally, we wanted to flag the COVID VAT deferral application. So this obviously just came online yesterday. A lot of businesses obviously deferred a lot of their VAT that they had to pay to HMRC. That deadline is fast approaching, which is to be paid on the 31st of March. But the Chancellor did announce that there would be a further deferral scheme that you can opt into, and the key word being opt in, so that you can then apply to defer or pay that over 11 monthly installments or less, depending on when you submit that application. So our advice would be get your applications in early if you want to make the most of the monthly installments.
Brilliant. Thank you very much, Ish. We've come to the end of the hour, and I did promise we'd close on the hour. So I just want to say thank you to everybody. We will send the recordings round. Those that have asked questions, we will come back to you if we've got your contact details in response to your questions. But thank you all for listening and to our speakers, and we'll see you again the next time. Thank you very much.